Okay, so this is part two. I messed up on the recording already, but we'll get used to it. So this is TR 17.2. Let's just assume that the tax rate is always 25%. In the textbook, they change it to 28. Again, that's not that realistic, but let's look at it this way. So we know that in '05, we paid tax of 125, it was 105,000. Okay, 25% times 420. And in 2006, we paid 75,000 tax. And in '07, we paid tax of 52,500. Now, something happened. We had a disaster in '08, okay, where we had a loss of 1.5 million. So, first of all, we're not going to pay any tax in '08. And in fact, we're going to get a refund. Why? Because we want to use our loss carry forwards, okay, or carry back, whatever we're gonna do. And this way, we're gonna carry it back. Why? Because we only have 3 years to carry that loss back, okay. And after 3 years, we can only carry forward. So we want to use as much losses from prior years as we can. So the first thing we're gonna do for '08, okay, is go back and get our '05 tax payable back. Okay, so in '05 we paid tax payable of 105. Now we're going to get that back as a refund. So how much do we got to go? So 1,500,000 minus the 420. Okay, we are at. I gotta get a calculator here. 1,500 minus 420 is 1,080,000. Okay, so we were taking care of '05. Now let's go to '06. So this is I'm just gonna put a '05 here. Now '06, we're gonna get back the 75,000 that we paid on the $300,000 of net income. Okay, so we're still using up 300,000. So now we're at $780. Now for '07, we're going to get back the 52,500 that we paid out. Okay, which would be 210,000 of income that we're going to use minus 210. So 570. What's the 570 represent? The 570 represents the loss carry forward that we can use. So of that 1.5 million, okay, we carried back to get refunds of the tax we paid for '05, '06, and '07. The remaining amount, 570, is going to be carried forward. So let's just say in '09, our taxable income was 500,000. Okay. Well, again, for 500,000, we're not going to pay any income tax. Why? Because we're going to go use up the remaining loss of the 1.5 million. We've grinded it down. Now in '09, we have 570 left. So we're carrying it forward. Okay. So we're going to carry back. We're going to carry that 570 loss forward. So that $500,000 now that we had in '09, okay, we don't have to pay any tax on it. Now we're grinding it down. We have $70,000 left of a tax loss carry forward to use to shelter against any income. So let's just say in 2010 we make $100,000. Now we're not going to pay 25% on $100,000. Why? Because we still have $70,000 of a loss. Okay. So from there, 100 minus 70, we're only going to pay tax on $30,000. 30,000 times 25 is $7,500 in tax. Okay. So you're always tracking it back and forth, back and forth. That's the part that that gets confusing. Okay. Now, let's change this scenario up. Okay. Let's change the scenario so that at the end of 09, okay, yeah, we had $500,000 of net income. Okay. We sheltered that net income against with our loss carry forward of $7,570. So what's left? $70,000 of tax loss carry forwards. Okay. So let's change this scenario. In 2010, let's just say we lost another $100,000. All we're gonna do there is we're not gonna pay any 25% tax. Okay. So all we're doing there is we're adding in the net loss. So now we're gonna get to carry forward another $100,000. Okay. Now, we don't really have to worry about. We have to always track going back 3 years. Now, you should track each loss separately when you want to go forward, because that $70,000 is going to expire 1 year earlier than the 100. But the reality of it is, no one's going to carry forward losses 20 years, because if they have to carry forward losses 20 years, they're going to go bankrupt in about 3 years. Okay, so that's the thing. They say you can carry forward 20, but it's really never going to happen. Just the way businesses need to make money. Okay, I don't even know what's going to happen now with the way the economy is going. We sat in class a month ago. We talk about the stock market. We look at the stock market, but just everything's tanked. So, we're going through a scenario right now where it's not record breaking, isn't, but we watch those videos about Enron, and we watch those videos where the stock prices have just tanked. So, what's that movie, The Big Short? Okay. They talk about the housing market crash. Well, that was one sector. What's happening now is every sector is just down. So, the losses that companies are going to take are going to be massive, and a lot are going to use this scenario. Now, we talked about a company taking the big bath. Okay, that's an example back in Intermediate Financial Reporting 1, where management is trying to massage the earnings. Okay, so a lot of times companies will use this as a crisis to write off all their bad debt, to write off any assets that they're never going to collect. Why? Because they know already, the accountants know that 2020 is going to be a disaster. Okay, so why not take the hit now? Because everybody's going to take the hit, and then next year they'll come out smelling clean. Okay, that's referred to as the big bath. You're going to take all your losses in a time period where things are rough, and then you'll kind of come out clean. You're going to clean the balance sheet up, get rid of all the garbage, all the uncollectible accounts that you might have, and then you're just basically going to start over. So I hope that is a good example of using tax losses. We can go over and over and over again. It just depends on the scenario, okay, of what's happening with the company. Now, in your first year, you might have a loss of $100,000 in your year one. So all you're going to do is use that $100,000, and you can only carry it forward. So again, you might not have a tax bill for a couple of years. So hopefully that gives you a better idea of dealing with tax losses. Okay, and in the end, you got to remember, you also ultimately have to make your journal entry, and that journal entry is always going to be income tax receivable, and you're going to credit income tax recovery. Okay, so DR and CR. Okay, so that wraps up chapter 17. Again, just a quick review of using those tax losses depends on your scenario, okay, or the scenario of the company. If anyone has any questions, please let me know, okay? and then we'll go from there.